Great. So once again, let's look at for IAS 40. We talked about investment properties. So IAS 40, that we will look at what? Investment properties. Investment properties. IAS 40. Investment properties. For the purpose of this video, kindly get the lecture material and follow us. Please, we are going to look out for a summary. So, quick summary of the standard and enter into question solving. But the agenda for the day is on the questions, but we just highlight on key sectors or key sections of the IAS 40. If you want to get a full picture of IAS 40, kindly use the main video. This is the question solving of IAS 40, summary and question solving. Okay. Now, in summary, if you pick every standard, you should know what? Number one, objective and scope of that particular standard. Number two is the terms stated in the standard. Number three is the recognition. Number four is the measurement. And some few issues that is stated in. Number five is the disclosure. Disclosure requirements. So these are the basic items that we should know about each of the standards. So every standard that you pick, at least we should know that outside the most important ones, the recognition and measurements, and sometimes the terms stated in there. So I'll go straight. Objective of this standard is to prescribe the correct accounting treatment of investment property. Scope. We'll look at the scope as the examples. So I'll go straight to the terms. The first thing is to define the investment property and other terms stated in the standard. Now, I'll go by this. So I'll define some of the terms, especially investment property, and go to recognition, and finally land myself on what? Measurement. So let me just summarize just 3 sections so that we enter into what? Question solving mode. So let's see. So terms, the first term that we have to explain or be familiar with is the definition for investment property. The definition for investment property. Now, the investment property, the definition is a bit lengthy or longer, but I'll break them into 3 summaries. Now, when I ask you to define investment property, don't forget that definition means give us the standard version, the standard meaning. Explanation means your own terms. That is all. We can equally offer us the standard definition as an explanation. We will take that. So investment property is defined as what? It's a property. So the first term is what? Property made up of land, or building, or parts, or both. That's all. So investment property is a property made up of what? Land, or building, or parts, or both. That's the first feature. So it tells me that you cannot use what? Motor vehicles as investment property. No. It must be made up of what? Land and what? building. So my question in advance is, what about container and kiosk? Can also qualify? Let's see. Number 2, acquired with an intention not for use, in production of goods and services, not for use in production of goods and what? Services. Or for sale in an ordinary course of business. Ordinary course of what? Business. Now, first point is saying that a property made up of what? Land, building, or part of a land, part of a building, or both land and a building. Point 2 is saying that acquired with an intention not for use. So with an intention not for use in production of goods and services. In simple quotes, not for use or sale. That is all. That's what this point means. This point simply which must be land and what? Building item. That is all. So acquired with an intention not for use in production of goods and services. So why should you acquire a building or a land or a part of a land, both land, the building? That one, you said it is not for use. That means you will not operate in. Second, not for sale. Wow. But what for? Let's look at the reason for the acquisition. By what for? So why would a company who is into profits earning more will buy a land or a building that the agenda we are not going to use it? So what for? So that's the reason. But for rental income, or long-term capital appreciation. Capital appreciation. Or both. Oh yes, it's true. Or both. So why do you acquire such a property? You acquire a property, one for rental income or capital appreciation. Probably I have a piece of land at some place. Currently, the price of the land over there is not appreciable. It's quite low. For instance, Pram. Now they're about to build airport there. So probably after the airport, the price over there will increase. Therefore, I can sell it at higher amount in future. So now, for now, let me just not touch it. That's all. So the reason is for rental or capital appreciation. That is all. So if you summarize this, when I ask you to define investment property, this is the word they want. So combine these three pieces together. So you start from property and end at both. If you're looking for a standard that could have a lot of or definition that have the highest number of or, is a definition for investment property. The all is about 5, just in one definition. Good. I was just informed that there are about 6 in them. So that's all. So that's the definition for investment property. That is all. Now let's look for specific examples of investment property. Now, before that, I promise I'll tell you the scope. Now, this can apply to all properties except 2 of them. 1, biological assets and mineral rights. So the exception, so biological assets and mineral rights do not form part of what investment property. That's all. Okay. Now, example number 1, examples of investment property. I'll just come to number 1. Property acquired for long-term capital appreciation. This is a very common one. Property acquired for long-term capital appreciation. So property acquired for long-term capital appreciation, right? Number 2, property leased out and operating lease. Under what? Operating lease. Number 3. Number 3. Property. The reason why we mentioned property, land or building. Okay. So property acquired and finance lease. And and rented out. Number 4 is very tricky. So let me explain this, and then friends online, you tell me how to treat this. We have a property. The entity or the company, you are an accountant, and then you have constructed a new office, a new building, but we are done with the construction, or construction completed, but you have not made the decision whether to, 1, use the asset, or to rent it, or to even leave it like that, oh, just for building sake. No, you have not determined the decision. Can we classify such building or such property as what? An investment property? Well, you have not determined the decision, so you have not determined the use. You do not make the decision. The decision to use the asset or to sell the asset have not been what? Determined. So friends online, can you tell me whether such asset we can classify it as what? Or we can classify as investment property? Yes. So it should form part of the investment property. So in simple quotes, any property held for undetermined use Decision to use the property has not been determined. Decision to use the property has not been determined. So decision to use the property has not been determined by the entity. Yes, so we have to classify it as what? Investment property. Until the entity makes the decision to probably release the asset for official use or office purposes, then it ceases to be an investment property. So add that one 2.4. So let's call it property acquired for undetermined use, or where the decision to use the asset has not been determined. Okay, so take note of that. Now let's go through the following. The following are not examples of what? Investment property. The following are not examples of investment property. So take note. So I'll list those that are not qualified to be an investment property. So there's a special one that I have to explain to you. Point number 5. Special one. I think I'll do that. In summary, example 5 of investment property is very crucial. Example 5 is property acquired by an entity and then leased out to a subsidiaries. So parent company acquired property, or parent company leased out property to the subsidiary under operating lease. So under operating lease. Okay. Now this is the issue. In parent book, how are you going to treat this? In parent book, example 5, in parent books, how are you going to treat it? In a subsidiaries book and then consolidation. Also, so how do you treat this? Take note of this, very important. Extremely important. Parents have rented some piece of what? Land or building to their subsidiary, taking some rental fee. So in parent book, but the subsidiary is using this office. So using this office, it generates earnings. So in parent book, parents shall account for it as what? IAS 40, investment property, yes, qualified. Subsidiary book, you account for it as what? Rental, public rental expenses. Good. But in consolidation, it is what? IAS 16, owner occupied. So take note that in consolidation, we will never agree that asset should be accounted for under investment property. That's IAS 40. So take note, when parent company lease out a building to a subsidiary company, in a parent book is a IAS 40 investment property, fine, we agree. But in consolidation, it's not an investment property, it's what? PPE, owner occupied, PPE. So take note, it's very crucial. Okay, so that is it. Now, the following items are not examples of what? In fact, they are not investment property, so take note. The following items are not what? Investment property. I'll list them quickly and then run away to recognition. And I'm getting to the tail end of the game. So the following are not, but they are not to IP, investment property. Number 1 on the list. Property held for sale in an ordinary course of business. So property held for sale in what? An ordinary course of what? Business. Your normal trading. So if you deal with lands and building, so like the real estate developers, the lands that are ready for sale, building that are ready for sale, they are not investment property, but they are what? That is IAS 2 inventory. So they must be accounted for under what? Inventory, IAS 2. Take note. Example number 2, item that are not what? Investment property. Owner occupied. Owner occupied property. The owner what? The owner is occupied in. So what happens is this. With the owner occupied properties, they are accounted for under IAS 16 DP. The owner probably using it. Then number 3, asset constructed for a third parties. Asset constructed for third party. And then properties that are constructed for or developed for future investment property. Properties that are constructed for future development property. Sorry. Property that have been constructed or developed for future use as investment property. Good. Now, the last one I'll talk about is I talk about 3, so let me go to 4. 4 will be property leased out. Property leased out and finance lease. You know that if you lease out a property and a finance lease, you cease to be the accounting owner. We are not talking about legal owner, accounting what? Owner. So in accounting terms, you don't have the right to record the asset in your books. And you cannot use someone's property as your investment property. No. Item that provide benefit to someone, you cannot use it as what? Your investment property. So let's take note of that. That is all. So now we are done with the examples of investment property. Now let's go straight to recognition. Recognition of investment property. Now here I'll not talk much and I'll not even say anything. So let's move on. That's I'll not say anything. I have to say something too. Okay. Under recognition, we are saying that how do you treat investment property? Is it a liability? Is it revenue? Is it an expenses? Is it equity? Or is it an asset? So tell the examiner that investment properties are what? Assets, preferably non-current assets. If and only if 2 conditions exist. If the following conditions exist. Following condition. Number 1, you know them already. It's the same condition we described under IAS 16. So let's move on. Under IAS 16, what we said, 1, it must be probable that future economic benefit will flow to the entity. And then the last one, the cost of the assets can be measured reliably. So these are the conditions that must be there before you can record the property in your books. So we are done with recognition. I'm going to measurement. And from there, we look at transfers. And that is all. Wow. What a good news. So measurement, summary. There are 2 types of what? Measurements. We have the initial measurement. Initial what? Measurement. Now, in fact, most of the initial measurement, they are at what cost? Most of the initial measurements, they are at cost. So the initial measurement of investment property 2 is at what? Cost. So initial measurement is at what? Cost. Good. It must be measured at cost. Now, it's at cost. I'll not talk much here. The cost is the same as IAS 16 cost. So IAS 16 initial measurement cost, basically the same. So when we reach there, I inform you that I'm going to make this one 3 times, right? This is the 3rd time. So that means I'll not talk about it at all in the summary stage. Okay. However, there are some specific costs that we have to exclude. It includes all costs incurred except for the following. Number 1, startup cost, unless to bring the assets or to make the assets ready for its intended use. So setup cost should not be part of what? Cost of the investment property. So setup cost or startup costs. Then the second point is operating losses. All this one, we treated them under the IAS 16. So in some stage, I may not be able to mention it. Now let's go to the subsequent measurement to end the game. So we can start with the question solving. Subsequent measurement. Subsequent measurement. Now, subsequent measurement means measurement after the initial recognition. The entities should select between what? 2 models. 2 models, what are they? We have what you call cost model, cost what? Model. We have what you call revaluation what? Sorry, not revaluation. Fair value model. Fair value model. There are 2 models permitted under the IAS 40. Select any of them. That's the good news. The good news is that under IAS 16.2, there's IAS 16, and this is IAS 40. That's the good news. The good news is that IAS 16 also have 2 subsequent measurement bases, or like 2 models for subsequent measurements. They are that one too is also called cost model and revaluation model. Revaluation model. The good news is that the cost model here is the same as the cost model here. So that's the good news. So cost models under the IAS 16 is the same as the cost model under the IAS 40. There's no difference. So tell us that if under IAS 16 PPEs are depreciated under the cost model, the same thing applies to what? The cost model under IAS 40. Let me repeat. If IAS 16 cost model, we depreciate PPEs under cost model, the same thing applies to what? IAS 40 cost model. So investment property too, you can also depreciate them if you select the cost model. This is just a matter of a decision by the company. They should decide and pick one out of the 2. That is all. So these and these are the same, so I'll not read it again. So if you need any further detailed explanation, you can use IAS 16 cost model. That's all. Now, fair value model. However, the fair value model here is not the same as what? The revaluation model. This one, they are not the same. There are differences. Even though the word fair value sometimes are the same as what? Revalued amount. Even though fair value is the same as revalued amount, but over here they are not the same. No. Fair value model is different from what? Revaluation model. Now, let's look at the differences in summary. Then we look at transfer. Then we assign with IAS what? 40. And I'll solve 2 questions under this. Then we say bye-bye to IAS 40 and start with the IAS 20, that's grant. Okay. So let's go straight and look out for the differences between the fair value model and what? The revaluation model. Take note of these differences. We've asked before. We've asked this particular question before. I'll send you some list of questions on these areas. Can you look at them carefully? Great. Okay. So I write here IAS 40 IP. Then I'll write here IAS 16 bracket PP. This I will call it fair value model. And what? Revaluation model. Please, if the examiner asks you to find the differences, don't come and tell us that one is called fair value model, one is called revaluation model. No, if you do that, minus one. One is an IAS 40, one is an IAS 16, one is called investor 40, one is called PP. No, please. We don't want that. Go extra. Give us specific accounting treatment which differ from these 2 models. How we get it? Give us the accounting treatment that materially or significantly different from that of the treatment. We are looking for accounting treatment, not just mere names. Besides, before we start the question, we mentioned this one for you. Because before we start the question, we told you this. What is the difference between fair value model and the IAS 40 and revaluation model and the IAS 16? So we've already mentioned that to you. So don't use them as the difference. Difference number one, or the distinguished feature number 1 is depreciation. Depreciation. And the IAS 40 fair value model, no depreciation. You don't depreciate the asset. No depreciation. So take note. All property held under fair value model, we don't depreciate them. So in the question, if it is fair value model for the investment property, please don't depreciate it. This one, I'm begging you, don't depreciate it. But IAS 16 revaluation model, yes, we charge depreciation. Yes, we depreciate it. So we depreciate the asset. So there's depreciation. Yes, there was depreciation. The asset must be depreciated. Here we don't depreciate. What again? Number 2. How do you find the carrying amount? So how do you calculate the carrying amount? Giving you the distinguished features. Carrying amount. How do you find the carrying amount? Under the IAS 40 is equal to the fair value at the end of the reporting period. Are you saying an IAS 40, the carrying amount of the property is nothing by the fair value at the end of what? The period. Fair value at the end of the period. Great. Fair value at the end of the period. Fair value at the end of the period. What about revaluation model? Current amount is equal to the revalued amount. Revalued amount with the same as the fair value and then the period. Less subsequent what? Accumulated depreciation and subsequent accumulated impairment loss. Have you seen the difference? This is what we are looking for. Not IAS 16, not IAS 40. Number 3. In fact, I'll give you 4 and you try and add just 1 to it. So that will add, you smile. In any of your exams that you write, you smile. Okay, so number 3, changes in the fair value. Where do you report it? So changes in what? Fair value. Let's go to here first. Revaluation gain, where do you record it? That's the changes in the fair value. If it's revaluation gain, where do you record it? Revaluation loss. Generally. So here, fair value gains. So gains are reported in where? Are reported in OCI, which is the same as what? Other comprehensive income or the revaluation reserve. Good. Gains are reported in where? OCI or the revaluation reserve. What about losses? Comma. And losses are also reported in where? Losses are reported in your profit and loss, your P&L. Full stop. No reverse here, except it's reversing previous or previous gain coming down here. What about investment property? So here, all gains and losses are reported in what? In the P&L, that's all. So if it's a gain, it goes to the P&L. If it's a loss, still the same P&L. But over here, it's not like that. Gains, one side. Losses, another side. We are done. Yes, not like that. So check the difference. So the question that we are going to pick right after this and solve, can you bring these features out? I'm begging you, can you bring these features out? The last one I'll give you. So you add just one. So that to be 5, at least 5 points are okay than 4. Now, maybe revaluation can be applied to all non-current assets. Yes, you can revalue all your non-current assets. All what? Non-current assets. What about investment property? Only property. Only what? Property in terms of made up of what? Land or building, or parts, or both. So not every asset or non-current asset that can be used for investment property. If you are renting your office tables, office chair to some company, please don't classify them as investment property. They are not land, they are not building. Okay. So assets. So the types of assets, bracket type. How we get it right? So that's it. So on that note, we are done with this one. Let's move on to the transfer. That's the last aspect of investment property. Transfer. Right after transfer, probably that's all. Then we are done. And then the derecognition of IAS 16 is the same as the derecognition of what? Investment property. So take note of that. give recognitions, meaning at what point do you stop recording this property as what investment property? You stop when there's a what disposal or there's been a transfer. Good. Okay, so I believe just some few points down, right? So now let's go to the transfer. If you have some few points. Now let's go to the last aspect of IAS 40. So everything you need to know is what you summarize it here. Wow. If you're able to get it, don't need to worry at all. Transfer. Transfer. Very important. Highly examinable. Very important. Transfers. So something like transfers. Let's see transfers. Basically, we have three forms of transfer. Three forms. Number one is like this. You can transfer between the cost model and fair value model. So transfer from cost model to fair value model. The reverse is also true. You can also transfer from where? Fair value model to the cost model. But you have a property where the inception you're using what? The cost model. But later on, you decided to use what? The fair value model. It allows. So take note. Number two, transfer between PPE, owner occupied to what? Investment property, IP. And the reverse is also what? True. And this section is highly examinable. Highly. Shall I understand this? Highly what? Examinable. You have an office property, your head office is at least say Kumasi. Head office at what? Kumasi. And then you relocate the head office from Kumasi to what? Accra. So now the Kumasi building became vacant or empty. So what do? You try to also lease it out an investment property. So that transfer from where? PP to what? Investment property. And likewise, can also move from investment property to what? PP. Take note. Now the next transfer is like this. 3. You can also transfer from IP, investment property, to inventories. And the reverse is also true. Up to inventory. So take notes of this. Great. So in summary, these are the transfers that are available. Cost model to fair value model, or fair value model to cost model. And also transfer from PP to investment property and investment property to PP, highly examinable. Upon all these three, these are the section which is what? Highly examinable. Then investment property to what? Inventory, and inventory to investment property. That's all. So I'll pick the very first question to do the illustration. Okay. Now, before I pick I start with the question solving, a simple code. Most often it will be like this. It will be PP, and then you transfer, let's say here, to IP. investment property, and this is a year end. This is a year starting point of the year. So that means from here to here, the property was what? PPE, take note. So depreciate it according to the policy of the entity. Whether they're using cost model or evaluation model, fine. On the day of the transfer, the standard is saying that do a proper transfer, or do the sacrifices well. So what you do is this: that day, get a current amount of the assets and get a fair value at that day, the day of transfer. Any differences, kindly use revaluation model to account for that difference, whether you're using revaluation model or not. That's what the standard is saying. So we are saying that at that date, make sure that you compare the current amount. Let's say fair value is 100, current amount is 90. So there's a gain of what? 10. The standard say that I think that this gain is what? Revaluation gain, and treat it as if it was revaluation gain. Even though you have not probably selected the revaluation model, you are using cost model. So if you are using cost model, still account for this difference as what? Revaluation gain. And then at the end of the reporting year, let's say here is 120. Okay. Then this gain goes to where? The difference between this and this goes to the P&L. Where the difference between this and this goes to where? OCI. That's the difference. Okay, so we are done. Now let's pick just 2 questions and then we move on to the next standards. So let's do this particular question. Let's see this particular question. Let's see this particular question. Okay, so let's see how best we can look at this. Okay. So let's go through the question. It's that QRS Limited prepares account certified December each year. It acquired an administration block. It acquired an administration block. Now, point blank is what TP goes for administrative purposes. With an estimated useful life of what? 50 years at a cost of 22 million on January 1st, 2006. The entity used the building for 5.5 years until 30th June 2011, when it moved its office to a new building at the factory site. The building was reclassified as what? Investment property and leased out under a 40-year lease. The fair value of the building as of 30th June 2011 was 24 million, and as December, the fair value was 24.4 million. Required. Explain the treatment of the building 2011 financial statement, that is the income statement and statement of financial position, on the assumption that the entity uses the cost model for investment property, and then B, fair value model. So you are performing this calculation both under what? Cost model and what? Fair value model. So this is the explanation. The entity, let's draw a nice number line for this. And that's all. This is January 2011. This 2011 financial year. June, something happened. So June, they did a transfer. So it was transferred So for mere comment is PP. For mere comment is what? IP. I know IP, we have two scenarios, fair value model and what? The cost model. So you are going to prepare first on assumption that you are using what? The cost model. They are saying the investment property, we should prepare one if they use cost model. For the cost model, don't even worry yourself. Cost model here and cost model here are the same, no difference. So don't even worry what yourself. Because cost model and a PP, cost model and a what? Investment property, no difference. So just calculate 1 year depreciation and share them. Here is 6 months, and here is 6 months. So don't even worry yourself. Tell the examiner that under the cost model, the asset must be depreciated. So just calculate 1 year depreciation for all of them and share 50-50 because 6 months, 6 months. Even though I'll walk you through the due process. Then B, assuming that there is a fair value model. That is where the challenge is because under the fair value model, we don't depreciate investment property, so no depreciation. So the depreciation will be up to here. Good. Then second, at the day of the transfer, any gain must be reported under revaluation gain. That's all. Let's quickly look at this. So for the cost model, it's not something which is difficult. So it's not difficult. So on a cost model, so we are looking for the income statements. So QRS Limited, this is the income statement. This is a financial position. First, depreciation. With the depreciation, calculate full year depreciation. So the cost is 22,000, right? Divided by 50. And depreciation will be what? Full year depreciation. Don't even worry yourself to demarcate it. And that'll give us, even though when you calculate for the current amount at the date of the depreciation, you get the same answer too. So we had 440, right? So it means that if we should calculate it, the transfer took place June, right? If I should do a comprehensive analysis, I can start like this. From January to June, depreciation will be 22,000 over 50 times what? 6 out of 12. I'll get 220. Okay. Don't worry. Now, the current amount of the asset, they've used it for 45 years. So now the current amount should be the 45 years remain all over the 50 years times what? 22,000. What's the answer? This becomes the current amount to remain. This becomes the current amount as the beginning of what? The year. Then we will take off 220 from it. Or you can make it 4.5. Yes, let's make it 4.5 to save the game. Now, let me explain why I'm doing this. We bought the asset for some years ago, and they were told that 5.5 years, so 5.5 years ago, is when we did the transfer. So let's say this is the date. This is 5 years, and it's 5.5. So how many years remain? If the asset is going for 40, if the asset is going for 50 years, then she left with what? 44.5. The entire life is 50 years. We spent 5.5, right? So left with 44 years. In fact, to find the current amount, the last time we went through the shortcut approach to get a current amount. So can we divide 44.5 over 50 times 22,000? We just want to find the current amount. It's the same as you finding the accumulated depreciation as at this date and subtracting it from what? 22,000. You get the same answer, but I want to be a bit fast because it's not part of the main game. But all what I'm doing here, we don't need it because we've saved ourselves here. We've saved ourselves here. But I just want to provide another workings for those who want to go by the long approach. You get the same answer. This is what we get. So 45 dot. So 44.5 divided by 50 times 22123. That's 19,580. Okay. So that means the current amount is 19,580. 19,580. So therefore the depreciation will be 19,580. All divided by 44.5 times 6 out of 12. And this answer must also give us 220. This answer must also give us 220. So divided by 44.5 times 6 out of 12. Yes, that's 220. So for those who want a long approach, extremely long approach, very complicated one, you go by this before you can get there. If you sum up this, you get 44 with the same as this. So if you go, the examiner is saying that, oh, and the PPE schedule and the PPE movement, we are using cost model. And the investment property, we are also using cost model. Tell the examiner that, thank you very much. Depreciation, just calculate for 1 year depreciation. Don't even share them, because if you share them, this is how to be. You get the same 440, and don't need to do this in exam. So you. Okay, so that is that. So you've gotten your depreciation, right? So in the financial position, that's the balance sheet. All what will go there is IP, investment property. Do the workings. What is the cost? Original cost. The cost is 220 less accumulated depreciation. This is what a smart student will do when they will do the long approach. That one, you go extra, but the answer is still the same. So just tell the examiner that on a cost model, just a transfer. So it's the accumulated depreciation. So it will be 6 years, right? So it's bracket 22,000 divided by 50 years times 6 years. And that will be, so the same as you multiplying 440 by 6. And that will give us, so this answer, the same as you, this is 1 year. So cumulative depreciation. In fact, I should even use that approach so it can be fast, less accumulated what depreciation. This is a full year depreciation, so by 6, right? 440 by what? 6 years. And that will be, press online. 440 times 6. 2640. So 2640. You take it off. Then what do you get for that of the carrying amount? So let's 123. 19,360. So the current amount should be 19,360. That is the current amount. We are done. This is the cost model. Now let's quickly go to the revaluation model. That's where my interest is. I'm not interested in the cost model because from cost to cost, we've not done anything. Tell the examiner that when they change or when they transfer from cost model to cost model, they've not done anything. But the PP was under cost model. Investor property was under cost model. This one is not done anything. It's like you have there's an adage that if let's say an old person, let's say a grandma or old person dies or pass out, and you place the person by an old person, and you've not celebrated the funeral. You just postpone the funeral because definitely very soon the new person that you have replaced will also pass out. So that's the same thing applies to the cost model and cost model. Okay, so let's go to the game. So that's in the board. Going back on. We are looking at what? The fair value model. So fair value model, that is where my interest of the income statement. Fair value model, first depreciation. Let's calculate depreciation for the 6 months. This is January. The asset was transferred June. So for this month, it was PP. So depreciation for the first 6 months, 22,000 divided by 50 years times 6 out of 12. You get what? 220, right? That's the first 6 months depreciation. Okay. So let's do the illustration so that you can get a clear picture of it. So picture it this way. The cost of the assets, January is 2220. As at June depreciation is 220, right? Okay. Now we should find the carrying amount as at these dates, and then the fair value as at these dates. That's the next exercise to get what you call revaluation gain or loss. So how do you get the carrying amount? So get the carrying amount as at these dates. So let's go and then look at that. So workings. First, we are looking for the carrying amount or the revaluation gain or loss. First, what is the cost of the assets? Cost is 22,500. What will be the accumulated depreciation for 5.5 years? Who will tell us accumulated depreciation for 5.5 years? So if half year is 22, full year will be what? Will be 440, right? Okay. If a full year is 440, 5 years will be what? The third is under that 22 plus accumulated depreciation. So less what? Accumulated depreciation. Open a bracket. It should be 22,000 divided by what? 50 years times 5.5 years. The same as you multiplying 440 by 5.5. That is all. So what do you get? So 440 by 5.5. 2420. Perfect. I like the answer. So basically the answer is 2420. 2420. So what's the current amount? 2420. So therefore the current amount will be So this like this. So the current amount to be 19,580, right? Okay, so 19,580. This is the current amount at the date. So the day that they did a transfer, the asset carrying value is what? 19,580. Wow, that's powerful. What is the fair value? So current amount is 19,580. Now, what is the fair value at the same date? What's the fair value? So let's look for the fair value and compare whether arriving at gain or loss. So let's see. The building was reclassified as investment property and leased out under 40 years. The fair value of the building as at 30th June 2011 was 24 million. So the fair value is about 24. So here the fair value is equal to 24. So that means there will be some gain or loss. And that gain or loss should be reported through revaluation gain. So let's see the revalued amount of fair value, 24,000. So what will be the revaluation? So just call it revaluation gain. So the revaluation gain of the revaluation gain of 4420. Perfect. So 4420. We are done. That's the revaluation gain 4420. So now we have, after the gain, then we have fully ushered the building to what? Investment property. So that's revaluation gain. So we are done. Then at the end of the reporting period, this one must go to OCI. Then at the end of the reporting period, kindly look for the fair value. Don't depreciate it from here to here because we're told that investment property held and a fair value, we don't depreciate them. So that is it. So what's the fair value at the end of the reporting period? And let's see whether they've arrived at gain or loss. So I said that as at 31st December 2011, the fair value was 24.4. So there's extra gain of 0.4. That goes to the P&L. So in summary, this is how the financial statement look like. All right, here, other income. Fair value gain on investment property. There's a gain of what? 400. This one we are working in thousands, right? No, we're not working in thousands. It's a gain of what? 400. Let's take note of that. So there's a gain of what? 400. Then you go to OCI. That examiner, revaluation gain. We have 4420. 4420. So this is how the P&L look like. The balance sheet is so straightforward. Assuming this is a financial position, the balance sheet. Just bring your currency. That examiner, IP, investment property. In bracket at fair value. Just pick the fair value at the end of the reporting period, which is what? 24,400. That is all. Go to equity. Any figure that enters the OCI also goes to the equity. So there's a figure there, revaluation surplus. So write revaluation surplus, which is 4420. So that's the end of this particular transaction. If I do one, you do one. One-to-one mapping. Only join some few points together. If you do have any question, kindly ask before it reach your turn. Or if you try the last one that I will look at it, then move on to IAS 20. Now you are trying this just 5 minutes. Just 5 minutes. 5 minutes. That's work. Question 2, you are in just the I. Just the I. So the comment is saying that advice and method on how to account for the above transactions in accordance with relevant accounting standard. So Kantanka, just start from the first one, this section, up to this. That's all, 5 marks. Start work. You have only 5 minutes. Exactly. Okay, so let's solve it together. Great, now let's solve it together. I hope you watch the video. Now, it said that Antanka Limited owns a piece of property. It purchased on 1st April 2014 for $3.7 million. Wow, property. Okay, the land component of the property was estimated to be $1.2 million. At the date of purchase, okay, so at the date of purchase, great. Now, if the land is 1.2, the building will be what? Building element will be, so 3.7 minus 1.2. Okay, there. So let's go to the board. Let me do something here. All right, here, land, and then building here, and put total here, right? The land cost is what? 1.2 million. Yes, 3.7. So let's make it 1,200. Let's report in thousands. Let's report in thousands. In thousands, you'll be 3,700. And then this will be 2,500. 2,500. 2,500. So basically, that is it. So have you seen? Let's continue again quickly. Okay, so what happened is this. The useful economic life of the building, not the land, the building. Why do we need a breakdown? We don't depreciate what? Freehold land. But we depreciate leasehold land. So don't need to depreciate that land. So that's why they break it down for us. So take note of that. Okay, so the useful economic life of the building on this land. What you the building on the land, building what on the land, not that the land and building have what 25 years. It's going to be 25 years on 1st April 2014. Okay. Now, the property was used as the corporate head office for 2 years. So it means that corporate head office, that's BP, owner occupied, great, for 2 years. The building or the entire property was owner occupied for 2 years. From that date, on 1st April 2016, something happened. The company moved its head office to another building and leased the entire property for 5 years to an unrelated tenant on an arm's length basis in order to benefit from the rental income and future capital appreciation. Wow, I like this examiner. The fair value of the property on 1st April 2016 was 4.1 million. The land component is what? 1.9. Okay, so let's wait. Let's get a current amount at the date of what? The transfer. So get a current amount at the date of what? Transfer. So let's do that before you continue the game. So we need the accumulated depreciation, right? And the visit for how many years? 2 years. So open a bracket, 2,500 divided by 25 years, right? For how many years? 2 solid years. Let's be sure about the dates if it's 2 years. The bottom point, 1st April 2014. So the next year will be 1st April 2015. The next year will be 1st April 2016. Perfect. So it's a perfect one. So 2 years. That's the accumulated depreciation. So 2,500 over 25. That will give us 100, right? Yeah, it's 100. 100 by 2, that's 200. So therefore, the accumulated depreciation, land will be dash, and here will be what? 200. So what's the current amount at the date of the transfer? Kindly find the current amount at the date of transfer. So the current amount is 1,002. So the current amount is what? 2,300, giving us a total of what? Just 3,500. If possible, I hope you get it. Right. There is a past question to corporate reporting, May 2017, question 2AI. May 2017, question 2AI. Okay. This is the current amount at the date of transfer. What's the fair value at the date of transfer? Fair value at the date of transfer. Let's go to the question. Take the fair value at the date of transfer. It is on April 1st, 2016. Sorry. The fair value of the property on April 1st, 2016 was 4.1 million. The land is what? 1.9. So let's go. The entire fair value is 4,100. Land is what? 1,900. So building is what? Who will tell us the building? If the entire one is 4,100, and then the building, that'll be 2,200. Sure. 2,200. Okay, I'll take that. So here should be 2,200. So have you seen how we're solving the question? Okay. Now, what is the revaluation gain? Revaluation gain. So revaluation gain over here will be 700. And there's a loss of what? 100. Loss of 100, giving us a total of 600. Have you seen? When they move, you move. When they stop, you stop. If you go to exams, there's a question that you have no idea, just perform something like this. When they move, you move. When they stop, you stop. That's all. Those of all at the go. Okay, so let's continue the game. On 31st March 2017, exactly the end of that financial year, 2017. Okay, so the fair value as at fair value on 31st March 2017 is what? 4.8 million. Land is what? 2.1. The land is 2.1. So let's perform this calculation. So let's close the account of this. We've closed this account. Then this is at the beginning, at the end. So at the end of the year, what's the fair value at the beginning? So fair value brought down and fair value carried down. The brought down is the same as the old fair value, 1,009. The same as 2,200. giving us a total of 4,100. Now let's see. So the fair value happens to be 4.8 million. Land is what? 2.1. So land is 2.1. Land happens to be 2,100. So if the entire one is 4.8, the entire one is 4.8, that's 4,800. What would be the building element? So that would be 2,700. Agreed. So 2,700. So what's the fair value gain on the investment property? So fair value gain on investment property. This one goes to the P&L. This one goes to the OCI. So the fair value gain on investment property. Fair value gain on investment property. This is for 300 or 200. That would be 200, right? Fair value gain on investment property. Good. So that's 200. Then finally, this one is a gain of what? 500, giving us a total of 700. A total of what? 700. That is all. Now we are done. So how they should treat the item? So they need the extract. So I'll just put all this to the extract. Take note that this one goes to OCI. Go to where? OCI. But because this one happens to be a loss, we cannot send it to OCI. It must go to us, the P&L. But can we record them separately? Let's continue the game. There's an again. The estimated useful life or estimated economic life remain unchanged throughout the period. Land and building are considered to be two separate assets by the directors of Santanka Limited. So it means that do not add them together as one. No. Land is different from building. Yes. Land is different from what? Building. They are two separate assets. So that means losses of one cannot be offset or cannot be used to offset what? Gains of the other. Losses of one cannot be used to offset gain of the other. And that's what you see here. So they're just looking for someone that will do something like this for us, apply the personalized. So this is not needed in question like this. We don't need a total because they are separate assets. So show them or record them separately. That's all. This one goes to OCI, but this one goes to P&L. This one goes to P&L. This one goes to P&L. And that's the end of the game. 5 marks. We are done. We are done. So I'll provide the P&L extract. So let me do that one here. This, have you seen? We solved everything before we got to know that they don't need a total, right? As perfect. Going fast on. Let's look at the P&L. So Santanka Limited. Santanka Limited. P&L. And let's see this. Let's say in thousand. First of all, that year no depreciation. Why? Because the transfer was made right at the start of the year. The asset was transferred at the beginning of that year, so no depreciation. So it was fair value. It was fair value throughout the period, so no depreciation. So take note. But there's revaluation or loss. This figure 100 coming from where? The building. And there's one that will go to the P&L, the fair value gain on investment property. So right here, fair value gain on what? IP. Right here land, right here building. They say that they are separate assets, do not combine them. So land happens to be 200, building happens to be 500. Good. Then we move on again. Finally to OCI. To OCI. So can we record the other comprehensive income? And you record revaluation gain on the land, which was 700. Perfect. We are done. That's the end of the game. Finally, when you go to the financial position on the balance sheet, so let us know this is a balance sheet, right? IP, land, building. The land is 2,100, building is 2,700. That's all. So this, all these 4 or 5 solid marks, we are done. On that note, we are done with the IAS 40 fully. Let me quickly go to IAS 20. That is IAS 20, government grants. That's our next section.